Well, hello and welcome to another episode of the Lending Podcast. We are your hosts. I'm John Burnham along with Jeff Jones.
Hello.
And we are excited to be with you again today. We've got an interesting topic for you. We have a lot of calls about this topic, a lot of conversations around this topic. And if you're someone who's going through this scenario, just know that we are here for you. And there's a lot of different things that we can discuss and ways that we can structure loans to help you. And so it's really talking about how your marital status affects your mortgage, whether you're divorced, recently divorced, gonna be divorced, newly married, all those scenarios. Separated, we'll talk about all that.
No, that's good. So I love this because I don't hear this talked about very often. And but when we have our consultations, our initial consultations, I had one this morning with the borrower, and this came up of like who defines what marriage is when it comes to your mortgage application. It's because we have questions on the mortgage application. Are you married, unmarried, all that good stuff. And there is like a lot of gray areas where people are not sure how to answer that correctly. So this is good to unpack the different scenarios of what a mortgage specialist looks like on marital status and how that plays out with different programs that a lender offers you. So if you're a buyer out there and you're not sure how to fill out your application correctly because of your scenario has moving parts to it with your marriage, then we're going to talk about that. If you're out there and you're just trying to get good advice from lenders and something just doesn't sound right from that lender, then talk to another loan specialist because they might have more information. So I like that.
Yeah, I mean, at the very most basic question on the application, there are three options. You're either unmarried, separated, or married. And those are the only three options that we have on the application. It's a standardized application. And the interesting thing that really in Texas, we only have two of those. We have unmarried and married because
so no separated.
We don't recognize legal separation in Texas. Some other states, I believe, do. And so that question of, okay, we're domestic partners. We've never been officially married. Do I put married on there? Do I put unmarried? So we're going to unpack that as it relates to loan guidelines specifically, because we have this question often.
Yeah, so for those of you out there, just a quick outline of what we're hoping to talk to you about today and hope that it really helps is if you are a veteran and you're looking at a VA loan, if you're looking at down payment assistance and with like an FHA loan, those two are government loans. We're going to talk through what marital status looks like with those programs because they're different than what we call a conventional loan. A conventional loan is not a government loan, and so that plays out documents needed, and those documents help us make sure the marital status reflects that.
That's right.
And then we're going to talk about divorce.
Yeah.
And so that's our outline is government loans, non-government loans, and divorce, and everything in between.
Yeah, and how your loan's affected. So let's start with our veteran clients. I'll start with our eligible VA borrowers out there.
Thank you out there.
So thank you for your service. So you're either an active service person, active duty military, or you have your VA eligibility and you are separated from service. I think the question we get most often is if you're an unmarried couple, okay, so veteran who's eligible for a VA mortgage with a co-borrower and you're applying together and that co-borrower is not your official spouse and they are not eligible for VA benefits, how does that impact you? And what a lot of lenders may say to a
Get to the chapel.
Is go to the judge and get your marriage license, right? Go down to the JP and get married. And the reason for that is because if you're trying to qualify with both incomes on a VA mortgage, historically the general knowledge was you got to be married to use the VA benefits of one veteran and a non-veteran, okay, or one VA eligible and a non-VA eligible borrower. And the truth of the matter is there actually is a way to get approved with a VA eligible and a non-VA eligible borrower who are not married.
I
know.
Come on.
There's a down payment required. We're not going to go into too much detail here, but there is an option. However, the benefit of the VA mortgage most of the time is that you don't have to put a down payment down, right? It's a zero down loan. And so throwing a down payment on a loan when you're not when you don't really need to, in many cases, is something that most folks don't do.
Yeah, so reason why I yelled what really loud is
Yeah.
because most lenders I know don't know this.
Right.
And it's interesting. And so if you're out there and you're a lender and you're watching this, you're welcome. This is a good nugget of information. There is a way to have a non-married partner on a VA loan that's not in the VA.
That's right.
So it's not, you have to get married in order to put this person on the loan.
And the down payment requirement usually is 12.5%.
So that's the number. So that's it. They basically are saying this person needs skin in the game of their own down payment amount.
Yep.
And it has to be from that person.
Yep.
And so we have to source that funds to show that it's from the non-veteran cohabitating domestic partner.
And now what we look at, so we have a conversation with the client, and let's say the couple is not married and they want to buy a house together, okay? And the veteran, perhaps the VA eligible borrower, may be able to qualify for the mortgage by themselves.
Perfect.
So if they can qualify for the mortgage by himself or herself, then we could do the loan just in the veteran's name. You can always add someone to the ownership of the property after closing. There's nothing wrong with that. And we could do a zero down loan. So your marital status on a VA application will determine perhaps how much you'd have to put down, how to structure the loan. Hey, I'm going to be divorced soon, or I'm going to be married soon. That conversation can influence how we structure the loan. So it's just important to tell your lender what's going on with your marital status. It seems a little invasive for us to ask that, but again, it's a government loan, and we need to know so we can structure the loan correctly.
Yeah, and this is a good segue into an FHA loan. So VA, FHA, both government loans that we do a lot of benchmark mortgage that we love working for. We are in the top 2% of VA loans in America. Or is that just Texas? It's America.
I think it's U.S.
U.S., yeah, that's a nationwide stat.
As a company.
As a company, we're doing the volume in the top 2%. So we're competing against the big dogs. I know we're in 43 states, based here in Texas. But all that to say is we do a lot of VA. And the FHA guidelines, we also do a lot of first-time homebuyer FHA programs, down payment assistance. Both of those programs, we are really obligated to collect tax returns. Now, the tax returns are going to obviously say if you're filing with your spouse or not. So it will be stated if you're married or not on your tax returns. So the simple version is marital status will mirror your tax returns.
True.
Unless you just got married after you filed your tax returns.
Yeah, and why this is a big topic, an important topic, is because oftentimes in a partnership, in a relationship, you may have one person who has really good credit and one person who maybe has some blemishes on their credit from past issues or challenges or a foreclosure or a repo or whatever. And so you've got these credit blemishes. Now, if both borrowers have great credit, then that's helpful. Doesn't mean that the loan's going to get denied if one person has bad credit or needs some work on their credit. But what's important on a government loan, VA and FHA, is when you are married, your spouse's debts have to be included in the application. So if you have one person who's the majority breadwinner and the majority income earner, and their spouse also has a car payment, some credit cards, some student loans, some things that the main borrower and qualifying person does not have, we have to include those debts on the application.
Yeah.
And that can affect your ability to qualify.
So one way that I like thinking about it is you have your household. It's like a collective household of the married couple, not counting your kids, but the collective household of the two, the two parents. The government's looking at that. If you're doing conventional, it's just the borrower.
That's right.
That's listed.
Yep.
It's not the household that's being evaluated, just the borrower that's on the application. So government is like household, conventional is just the borrower.
That's right.
Listed.
And so if you are an unmarried couple on a VA or FHA mortgage, you can apply for the loan by yourself.
Right.
We're looking at your income. We're looking at your debts only. We're not looking at your domestic partner or partner's debts in an unmarried couple situation, right? And that comes back to the tax returns. If you're filing as a married couple, we're going to consider you a married couple. We're really going to what you tell us. You're
Right.
saying you're married, then you're married. You're saying you're not married, you're not married. But we're also verifying that through the documentation that we get
Right.
when it comes to government loans.
Now let's talk a little bit about conventional. As you know, many times in conventional, we're not even collecting tax returns, right? So how does that play out into what the client is saying about their marriage?
Yeah. So we're a community property state in Texas. Many states are. What that means is if you're married and you buy a house as an individual person, your owner-occupied residence, your spouse must sign the deed of trust. They are also on the ownership of the house. At the time that you purchase the home, they are on the deed, even if they're not on the mortgage. It's different for second homes and investment properties, but we're talking about primary residences. I'm buying a house to live in. I have a spouse who, and I'm married, let's say, that spouse is on the deed. And so to your question about conventional loans, you can apply for and qualify for and get approved for a loan by yourself on a conventional loan and not have to include your spouse's debts. You don't have to include their income. You don't have to include their assets. You don't have to include their liabilities on a conventional loan. However, if you are claiming that you are a married couple, then that person will be on the deed at closing. And this is going to be a segue into our kind of divorce spin on this discussion,
Right.
because the marital status affects how the property is deeded and therefore how the closing happens, right? And we got to have both people present to sign the closing documents, right?
Well, a side note, a refinance could be canceled by a spouse.
True.
So that's something to take note of because
Spouses have to sign. Yeah.
there's a right of rescission on a refinance, meaning you have 3 days, even after you sign your closing documents at title, where a spouse can change their mind and cancel the whole transaction. So that's
true.
I actually kind of like that rule because what if your spouse that you don't know is trying to refinance a house behind your back, but you still have ownership and obligation for it?
Yeah.
You know, it doesn't allow spouses to disagree on that.
Right. But both spouses have to sign documents pertaining to
On a refinance, yeah.
the application documents, and then especially if it's a cash out, and then pertaining to the
Right.
closing documents. So that's a good point.
Cool.
Yeah.
That was
so,
a segue.
So I think where this discussion originated today is we were discussing a current client that I'm working with who's under contract on a house or closing in about a month. And in this case, I've known the clients for a long time, maybe 15, 20 years. And so both the husband and the wife are past clients of mine. They are recently divorced. And so I'm working with the lady in this case, and both good friends with both of them still. Mm-hmm. But I'm helping the lady in this case buy her home as a recently divorced woman. Okay. So what we need to show is the decree,
Right.
the divorce decree, that she is, number one, the divorce is finalized. And again, that's important because it comes back to if they were still in the process of getting the divorce, then the soon-to-be ex-husband would need to sign those deed documents. Mm-hmm. And we talk a lot about, like on credit, we say people separate, but credit does not. And so when you have a legal binding separation with a signed divorce decree, right, a legal document that says these two people are now divorced, and so we have two individual borrowers, it's important that divorce is finalized before one party is going to buy something if they want to kind of remain separated from their ex, right? And they're not still intertwined with the new purchase. That's really important. So in this case, the divorce is finalized.
There's a timing concern.
Why
don't you talk about like what it means of like if you're going to buy it by yourself because you're in the process of finalizing your separation and divorce, but you want a house shop because oh my gosh, like you have to move.
Yeah.
Right. So there's a lot of movement happening of where you're living, and so you want to get the next place lined up.
That's right.
But you have to be careful not to go under contract before the decree is finalized.
Yeah, or
even
close.
If it's going to close after.
Yeah. The timing's super important. And as you can imagine, the calls we get a lot of times is when the divorce has been filed. So two spouses decide, okay, this marriage is now going to be over. the divorce paperwork is filed. There's a 60-day waiting period, I believe, in Texas before it can actually be signed by the judge. So you have this 2-month waiting period. But the moment that the divorce is filed, the paperwork's filed, that's a lot of times when we get the phone call. Because like you said, that may be when someone's moving out of the house and looking for an apartment or looking to buy a home, depending on what the situation is. And so we have conversations about how do you refinance the house? How do I get equity out of the house so I can pay off the future ex-spouse?
Right.
How do I divide the equity? So we discuss all those things. Of course, we're working with the attorneys and the trust attorneys, perhaps estate planners, whoever's involved. But typically, what we're doing is we're planning on qualifying one of the two people, right? Now, sometimes they may be selling the house, taking the proceeds, and then parting ways, just splitting the proceeds, and he's going to buy a house, or she's going to buy a house, or the two partners are buying a house, what have you. In this case, I'm working directly with her, and she's getting an equity disbursement from their joint asset, their house that has appreciated over time, and they've had it for, let's just say, over 10 years. So they have a lot of equity, and that money that they're pulling out of the home is coming from a home equity line, a home equity line of credit, but it's in the decree that she's getting X amount of dollars, right?
Almost like he's buying her equity out.
Exactly. Yeah. And then she won't have any ownership interests in the home anymore. I think per the decree, she doesn't have any ownership interest of the home. We're going to talk a little bit about that as well and how that affects qualifying, because she still has a mortgage on her credit from that house that she doesn't have ownership interest in anymore. So how does that affect things?
Right.
So we'll touch on that. But in this case, the divorce is final. It's signed by the judge. She has a settled, X amount of dollars coming from that property. That amount of money is not available yet, but we're already under contract to close in 30 days because she knows that she's getting that money in a couple of weeks.
Right.
So we've qualified her. She has her own income, own job. We're qualifying her on her debts, and she qualifies as an individual unmarried person, right?
Yeah.
And we don't have to use the ex-spouse's debts. We don't have to know anything about the ex-spouse because he's not involved, on this coming purchase.
Yes.
But if the divorce wasn't finalized yet, is a little different conversation. And sometimes that's where the waters get muddy.
Yep. So in our world of mortgages, we have a lot of eyes and basically positions touching a file, touching your loan documents. What that means is there's a lot of verification of every piece along the way. So we need a lot of documentation that is perfect, that represents the file correctly. So if we know that you are divorced, we need a copy of the finalized divorce decree, because an unfinalized divorce decree doesn't mean anything to us. So a lot of times we will get the draft.
And it's important to know, so we can
and
plan.
that helps gauge how the obligations will play out. So the things that show up on your credit report, knowing who's going to be responsible. Is it you or is it not you? We can exclude things that are not you because of the divorce decree. But eventually we need the signed copy. We need all pages of it, not just some pages of it. And then if there's children involved, then we need the child support order of who's obligated to pay what to who. So we know how that's going to affect your income. And we go from there. So the divorce decree, and if there's kids' child support order, we need both of those, all pages, fully executed, to really have underwriter say everything is covered, like we have the right representation on this file. So it's a little bit misunderstanding when people don't realize that we need those documents, because it feels invasive to a lot of people, and we get that as lenders. It's like, this is very emotional. It's very personal. You're asking for no one has seen my divorce decree but me and my lawyer, right? And all of a sudden this unknown person is asking for it, and who knows who else will see it. But we have to have that for the file. So when if a lender's asking for a divorce decree and child support order, they have to get your file ready.
Right. And it's not only to determine what liabilities you may have from the decree. In other words, one person's taking the Wells Fargo credit card, the other person's getting the Bank of America credit card, what have you. And you're sort of splitting these liabilities down the middle, perhaps. And the other flip side is what income is going to be received from the divorce decree and specifically child support order. And a child support, the income from child support indefinitely. Of course, it stops at some point, when the kids typically turn 18. But until the kids are 18, child or multiple children turn 18, there's a revenue to that spouse who's receiving child support. That can be used to help you qualify for a mortgage. There's documentation requirements, et cetera. But I think one technicality, I was talking to a colleague the other day, is she had a divorce situation with one of her clients, and the child was 16 years old.
Oh, was it a 3-year continuance?
And we have to have a 3-year continuance for the child support to use it to qualify. Obviously, 18 minus 16 is 2, so we had about 2 years left. And we were not able to use that child support income for the spouse to help her qualify. Now,
I like just one of my phrases that's kind of becoming a common theme in our podcast, I'm noticing, is the phrase ability to repay.
Ability to repay.
So people ask, that sounds stupid.
Yeah.
If I'm getting money for 2 more years, why can't you count it? Because this is real money I'm getting. And the reality is, in the lender world, we have the ability to repay rule, and the majority of those guidances are 36 months.
That's right.
So we have to have a continuance of that income for 36 months in order for us to actually show that it's going to happen.
Right.
Anyway,
and be able to use that income to qualify. Now, a lot of times you might be able to qualify for the house that you want without that additional income. That's the path of least resistance. That makes it easier, right? But if we need that, say $1,000 a month to actually qualify for the loan, that's where it becomes tricky. And I think those are the little snakes in the grass that get missed by a speedy online lender pre-approval that you get in 10 minutes, right?
Oh, yeah.
Because not all the documentation's been verified. We trust, but verify. Like we know our clients are filling out the application to the best of their ability, but if you don't do it every day, there's some questions on there that you might not know how to answer. Oh, yeah. And one of the things is the application does not ask if you pay or receive child support.
Right.
And so if you're paying child support and you mark no on the application, and then it's coming out of your pay stub, like we're gonna catch it. I hate to say that.
Or if it's Office of Attorney General back, owed is showing up on a credit report. We're like, hey, what's this?
Yeah.
OAG, Office of Attorney General stuff on here. So.
Yeah, so I think to kind of put a bow on this a little bit, obviously your marital status can impact your mortgage.
Yep.
And what we want to encourage clients to do is have that conversation about how your marital status is going to affect yours.
Right.
Because if you are, I'm about to get married in 60 days and we're trying to get through the wedding and then we're going to buy a house, like how does that impact once we get married? Well, again, coming back to that VA mortgage, if it's VA, that's probably a smiley face, because then you can go VA and you're a married couple and it's just cleaner, right? Because we're going to use both borrowers to help qualify and maybe potentially qualify for more home. On an FHA scenario, as an example, after the marriage and after it's finalized, if one person has a lot of debt load that kind of disqualifies you, you might want to close on the house before you get married, technically. So we can help guide you through that. It's really kind of like filing your tax returns, right? You're filing tax returns. You're taking the legal deductions that the IRS allows you, right? You're structuring your taxes to benefit you the best, but also, do them the right way. And that's what we do with the mortgages. Like, what guidelines do we have? What parameters do we have to work within? And making sure that we're structuring the loan correctly by educating you how the timing can affect your situation. And this is a little bit of a side note, but occasionally during the process of the home buying purchase, we have clients that want to open up new debt. They need to buy a car. They got in a car accident. We're actually going through that right now. My wife was in a head-on collision, kind of a minor head-on collision a week ago. Airbags deployed. We're going to be car shopping, probably waiting on the insurance settlement or insurance decision right now, and then we'll probably be car shopping, right? Thankfully, we're not buying a house right now, but if we were, that new car loan might impact our ability to qualify, right? So it has to do with our debt obligations, our liabilities, our assets, our income, and the timing of your marital status change can affect that.
Yeah. So, a lot of lenders out there want to roadmap how those changes play out. And this is where if you're not having good conversations with a lender, if you're just doing something online and you have these life changes happening with your marital status while buying a home, you really need to talk to a specialist and make sure they understand what timing will happen there.
Yes.
Because if those things aren't coordinated, all of a sudden, you might be 3 days out from closing on a loan and you realize the lender can't do it as they structured it. And then you're in that, oh gosh moment.
That's right.
Because it was structured incorrectly when those changes were happening.
Yeah.
So no one wants that.
Having the full picture. We talk about this a little bit with like a diagnosis of an illness and getting a prescription. If you feel really bad, maybe you think you have the flu or whatever, you don't usually just call your doctor and say, hey, I've got a headache and fever, can you prescribe me some medicine? You really want to go in and get tested and is it strep, is it flu, is it COVID, is it whatever, pneumonia, so you can get the full picture. The doctor, the nurse needs to figure out exactly what's going on with you so they can prescribe you correctly and not just partial information or we think it's this, so we'll prescribe that medicine. If we have a partial picture of your finances, it's really hard to put you in the right loan.
Right.
And like you said, snakes in the grass pop up, and that's our job up front, is to find out exactly what the full picture looks like, so we can give you that guidance and help you structure the loan the best way possible.
Good.
Yeah.
Wonderful. Marriage is what brought us together today.
Marriage.
Marriage.
You can't say the word marriage and just stop without saying the line from The Princess Bride.
It was always in my top 5 when I was like a teenager.
Yeah.
It was a great movie.
It was a great movie.
All right.
Awesome.
Well, thank you so much for tuning into the Lending Podcast. Our goal is to provide you good information, make good decisions, and really we want to hear back from you too. So please subscribe, comment, and let us know what you're thinking and what you would like to hear from us.
Thanks so much. Appreciate you being with us today.